Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
All right, good morning, everyone, and thank you for attending this morning's panel called Strength in Numbers, a guide to real estate syndications. We do need to give you a quick disclaimer, though. While the three of us on stage have syndicated multiple real estate investments, none of us are attorneys, and nothing we share today should be considered legal or financial advice.
We're correct.
Agreed. Or correct. We've all syndicated, and we've done it, but we're not attorneys, so always consult with your own legal and tax professionals before structuring or investing in a syndication. And before we dive into the details, let's take a moment to level set and talk about what real estate syndication really is. At its core, a syndication is a group investment where multiple people pool their money together to buy a property that would be difficult to purchase individually. It's how you take down a $10 million apartment complex or a self-storage portfolio without doing it alone. So in a typical syndication, there are two roles: the general partners, also known as the GPs or the syndicators, and these are the people finding the deal, putting it together, managing the project, and communicating with investors. And the three of us are and have been general partners. Then there are the limited partners, or the LPs. Now, these are the passive investors who contribute capital, get a share of the profits, but don't have to do any of the heavy lifting. Now, a deal is usually structured so that profits are split between the GP and LPs with preferred returns, profit sharing, and tax benefits all laid out in the offering documents. We're getting into the weeds, and we'll talk about this during the panel, but syndications can be structured under different SEC exemptions. So the SEC is the Securities and Exchange Commission. Anytime you are raising money from more than one investor, if two or more investors, you have a syndication, and you have to be aware of what the Securities and Exchange Commission rules are, because if you run afoul of those rules, you can get in a lot of trouble. So the two exemptions are 506B and 506C. Those are the most common types of syndications, and they control how you raise money, who you can raise it from, and whether or not you're allowed to publicly advertise the opportunity. So if you're trying to raise money for a deal and you just go on Facebook and say, hey, who wants in? You could get yourself in a lot of trouble. So we're going to talk about that a little bit today too. In short, syndication is a way for investors to leverage other people's time, expertise, and capital to access larger deals, scale faster, and build wealth together. So now it's time to introduce our panelists. Starting with Gary Hall on my right here. With over 2 decades of investing and property management experience, Gary Hall is passionate about real estate investing. Currently serving as the president of the Muskegon Area Rental Association and treasurer of the Rental Property Owners Association of Grand Rapids, Gary is a real estate broker, general manager for West Shore Property Management, and owner of Dean Arrow, a private equity firm managing several real estate funds. His mission is to help as many people as possible to build and preserve wealth. Keith Heckman has been investing in real estate since 2018 with a portfolio that includes single-family homes, duplexes, and multiple successful house flips. He's also an active private money lender and a limited partner in larger multifamily deals, including a 62-unit property in Fort Worth, Texas, and a vacation rental fund. Recently, Keith stepped into the role of general partner in a 52-unit multifamily deal in Charlotte, North Carolina, and his experience spans both active and passive investing, providing a well-rounded view of real estate wealth building strategies. And then I should introduce myself because I'm a syndicator as well. Most of you know me as the host of the podcast, a rental property owner and real estate investor podcast. I'm Brian Hamrick. And I've been syndicating since 2013 when I raised my first $500,000 to buy a 72-unit apartment complex in Lansing, Michigan. Since then, I've raised over $20 million, probably done at least 10 different syndications, funds, and have a lot of information to share on those. So with, without any further ado, let's get started here. And Keith, I think I'd like to start with you because you just syndicated a 52 unit apartment complex within the last year, right?
Yeah.
As a general partner. And you're somewhat new to the syndication space to some degree. So I think your experience getting into syndication, why you chose to do it in the first place, and what that experience was going through your first syndication was like. I'd love to hear more about that.
Sure. So as I mentioned, like probably a lot of you in here, I started out in single family, trying to get my feet into the door as a real estate investor, and then just thought about progressing into other roles between active and passive investing. Didn't really know about passive investing when I started, just thought you had to do this and all the heavy lifting on your own. And I thought it was easier to do by myself. So I could argue with myself and I would always win. So I didn't necessarily want other partners. I thought that was the way to go. But as I learned, it's much easier and actually more fun, I feel, to do it with people that you know, like, and trust. So I started to look at finding other people to partner up with. I had some mentors. I've talked to Brian multiple times. There's a couple other people I've talked to just to gain information from them. And that led me to a couple of options because I knew at some point in time I wanted to be a full-time investor and walk away from the W-2 like probably a lot of us do. But I wasn't sure how that was going to happen. So I worked backwards to figure out first, how do I retire my wife first? And then how do I figure that income to take place of her income? And Brian and I had a conversation. You may remember I started putting math together of how many doors I'd have to buy of single families to make that happen with the cash flow that you hope each door gives you. And I thought there's got to be a better way. This is going to drive me nuts. And then I started looking at syndications. I read about apartment syndications and thought, okay, yes, it's more work, but it's not that much more work, and it gives you access to a whole lot more opportunities across the country when you find operators to partner with that live in other states that you, again, get to trust. So that's what led me to syndications. I read a book. I'll give him a plug here. I read a book from Michael Blanc about apartment investing. It's a little yellow book. Highly recommend it. I would also recommend looking at other ones, but as I read it, I realized it was doable. It wasn't as scary as I thought it was. And so that led me to a conversation with Brian about his vacation fund that I invested in, I think 3 years ago as an LP. And then that led me into the one that I invested down in Texas. I got to know the operator there. And then that, again, along the way, I met more people, got to know them, understand what they were doing, and realized, let's look at the GP side of things. Because on the GP side of things, well, as Brian mentioned, you do a lot more work up front and you've got a lot more legwork to do. Sometimes it's easier because you don't need to put all your money into it. You're leveraging other people's money as a limited investors. And so you can take down some more deals with partners when you find those limited partners to put their money together. And but I like the idea of a general partner because I also wanted to learn about the ins and outs of asset management and what went on behind the day-to-day to put together a syndication and run a successful syndication.
Yeah, thanks. And so to sum up, you've done some LP, but in your own investing, you wanted to scale. So you kind of realized, okay, the way to scale is through syndication, pooling money together. And I'm curious, before we go to you, Gary, Keith, what was that experience of your first syndication as a GP? Like what did you find was different in being a general partner from when you were a limited partner, an LP?
Sure. And I'll take a step back too. This is not a simple get rich quick overnight. If you have read stuff online, you'll see people on LinkedIn. They're talking about hear about Brian. He's turned into success, but it did not happen quickly. There's a lot of people you'll hear say, oh, I did my first deal and I retired from my W-2. Not sure that that's realistic. So it's not as easy to do it quickly, but it's not as hard as I thought it was. My biggest problem was getting out of my own way and just doing it, because I bet a lot of you, when you started with your single family home, or if you're thinking about doing your first rental property, you're doing analysis paralysis and you're trying to figure out, well, what if this goes wrong? What if that goes wrong? Yes, you want to do due diligence, but you want to jump in and actually do it. And that's what it was like for me with a limited partner. I mean, Brian and I probably had 10 different conversations before I finally thought, okay, either do it or don't. And I did it, and I've learned a great deal from that one, which led me to that other LP. And then I realized, okay, GP's not that hard if you get educated. And that's the biggest thing I would say, that people that don't get educated, you don't know what you don't know. And I have learned multiple things at each level of syndication that I have tweaked how I will do things moving forward that will make me a better investor. And then also the benefit, I believe, with being a limited partner first is I saw what I liked or didn't like about those GPs and how they were running those deals. And then I could learn from that and say, okay, well, this is how I would fit that into my role as a general partner. So ultimately it was scary. I guess that's the easy way it was very scary. But I decided I had enough people in place that I trusted and I had enough experience, and I did the work up front to make sure they were good deals that I did it.
Yeah, thank you, Gary. So to talk about your experience, what was your first syndication like? And I know that you can make the distinction between single asset syndications and funds, because I know you're more geared toward funds, but just talk about your experience with that.
We tend to overcomplicate things in real estate because we're dealing with big numbers. It's a really emotional piece. There's the phrase that personal finance is 80% personal and only 20% finance. Syndication's kind of the same way. There is no SEC rule about syndication. It's about creating securities. And as Brian had mentioned, if you have one passive investor, that's you and another person, you now have two people and one of them's passive, theoretically that has created a security. So if you've ever had an investor that's given you money to do a flip or to buy a house, you've already done it. The only difference is what size you're going on. There's a lot of gurus out there. We all like, analysis paralysis. We all like to read the different gurus and see what's going on. Two of my favorite have extremely opposite opinions. Robert Kiyosaki, the Rich Dad, Poor Dad, and Dave Ramsey, don't get a single dime of debt. We've had a lot of discussions over the years about which way is better. I fall right in the middle. And as I've tried to find ways where I can increase and scale without going into as much debt, you still need opium, other people's money. And that's where I got into the syndication. So as soon as I could, why own one house when you can own, 1/10 of 10 houses? Your risk is diversified. You can immediately rest easier because you've got higher cash flows. Anything that goes wrong, one of your houses goes vacant or one unit goes vacant, you don't lose 100% of your rents. So in my experience as a property manager, I've always found that people with larger portfolios actually have an easier time managing their real estate. So while it might take a little bit more work up front, it's actually much more secure and safe to do a syndication as long as you're following the rules. So I bought my first house after 2008 when I lost my first duplex. When I finally got the nerve back up to get back into real estate in 2015, I bought my first house, made sure I felt comfortable, and then I said, okay, after that, I'm not doing anything without partners. And everything I've purchased since then has been through syndications and partnerships.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
So you mentioned having multiple houses, but you're talking about a fund. So talk about that, because like I've done both. Like the syndications I started with, and by the way, can you all hear us as we're talking? The microphones are picking us up. Okay, good. Thank you. When I started, I was doing single asset syndications, like an apartment building, apartments, self-storage. But then I did a note fund where we bought multiple note assets, and then a vacation rental fund where we have several assets in there. So I've done both, and funds really are the opposite of single asset. Talk about what you're doing in your fund and why you chose to go the fund route as opposed to the single asset.
Okay. So legally speaking, there's no difference. But as far as how you're describing to people, we typically talk about syndication as buying, large apartment complex, one building, and you're raising investors. You find the property first, you create the deal, you make sure it works, and then you go out and raise the funds for that property. It's really nice because it allows the LPs to understand what they're getting into, to do their risk and reward calculations based off that individual property. On the flip side, that's the only asset. There's no backstop. If that deal goes south for whatever reason, they lose everything. The fund model, once again, legally is the same structure, but what you're doing instead is you're raising the money first and then looking for the assets, and then you're pooling multiple assets together. I like that mode because I think cash is king. You can always refinance out and take that money, and so you're not locking everything in. But if you have the cash up front, I've been able to get better deals quicker and faster and help people. Being able to move fast and being able to diversify the risk is why I've always done the funds. As a property manager, as someone who's always investing, I always have more deals than I can find money for. So I didn't need to go out and find the deal first is probably the other reason. A lot of people, when they're first getting in, they don't have a deal. They don't have a source for deals. So if they go and find the deal, the money will follow. I always have deals. I just need more capital. Currently, the other part about the fund model is markets shift and change. If you get an apartment complex in a certain market, that deal might work great in that market the day you buy it. Interest rates can change a few years later, and going after that same type of asset in that same type of market no longer functions. Well, this is my day job. I don't want to have to shift gears as often. If I can raise capital in a fund with their knowledge that I'm running it for this style of real estate, as the market shifts, I can shift what I'm purchasing. I'm heavily invested in the Muskegon area over the last 5 years. As an example, the inner city was definitely where you wanted to be, but as property values have gone up, there's totally different markets, different clientele. You're no longer going after the D class. You now want B class. You're going to get similar returns, but the entire profile of what we're investing in has changed drastically. And I don't have to raise new funds for that. I already have it in my bank account. The hard part for the LP on that point is you are no longer vetting the deal. You're vetting the syndicator. You're investing in them. You're trying to find out if you trust them and can get on board with their vision for what they're doing. They fell out of favor after Bernie Madoff and a couple other people stole a lot of money. And so you can look online, blind pool investing. It was really popular for a while. It kind of fell out of favor, and it's coming back as there's more regulations and people are getting more comfortable, and they know that, with the internet, you can find someone's reputation out pretty quickly versus I met Bernie Madoff in a golf club and he was my friend's broker, so I'm going to use him. So with the ability of podcasts and being able to get to know these people and see their history over years and whatnot, these blind pools and these funds are becoming much more popular.
Yeah. So, by the way, I meant to ask before we started, has anyone here ever syndicated a deal? Anyone so we have a couple syndicators in the audience. Okay, great. When you syndicate, you wear many hats. And I'll talk a little bit about my experience, because there's the asset that you're acquiring, or the assets if you have a fund, and you have to know how to value those assets and do your due diligence on them, make sure that the return on investment is going to be what it is. But that's the physical property asset management side. But as a syndicator, you're also raising money. And that's entirely different skill. So you have to know how to market. You have to know how to put together a pitch deck. Ideally, you would have your attorneys put together your private placement memorandum, your operating agreement, your subscription agreement. In fact, if you don't have your attorneys do that, I'd say there's a problem right away. But there's marketing, there's fundraising, there's communication, because you have to let your investors know what's going on at every step of the way. And I'm wondering, Keith, which hats do you wear? And what was it like for you to go out and raise money for the first time?
Sure. So one thing I will let you know, those of you that have not either been part of or certainly on the GP side of a syndication. So to answer the question, on this deal, I was a capital raiser. The reason I'm saying this is you legally cannot just be a capital raiser for a deal and then step back, take your piece of the pie and your equity and then step back. That is a big no-no. The SEC will hammer you. If that happens, they will hammer the the managing membership team. A syndication requires everyone has involvement. So even though mine was capital raising on the deal in Charlotte, we just had an asset management call yesterday. We do them once a month. And I am not an asset manager, but I am involved in it. So I can have discussions. If I see something I don't like with occupancy dropping, vacant, or let's say evictions going up, we're all part of that. So it's not just, and I share that with you because again, you might hear things where, oh, capital raise, because all you gotta do is, raise $1 million, get some equity, get a little piece of the pie, and then you're done moving on to your next deal. If you do that, you're going to set yourself up for some problems in the future. So it is very important you stay in line with the SEC. So my first experience, it wasn't as great as I thought it would be. It was way harder. I had talked to multiple people that are potential investors that had interest in deals. I had been greasing the wheels, keeping in touch with them. It's a lot of grinding. It was more work than I actually anticipated. And it was tough. You've got to talk to your investors. It's all about timing. I have a couple of investors that have always told me, I want to know about your deals. If you got a deal, let me know. Well, for them, one of the deals I had, it checked their boxes of what they wanted to invest in, what they were looking for. And I called them up and they didn't have money at the time because, to Gary's point, if I don't have a deal, and I talked to Gary and he's like, Keith, your next deal, let me know, I'm ready, I got money. And let's say we talk today. 2 months from now, Gary, I found that deal that checks all your boxes. Sorry, Keith, I invested it somewhere else. So that you've got to have a massive amount of people. The other thing I learned is you get what's called soft commitments. So you'll open up that pitch deck, you'll talk to your investors, they'll give you, oh yeah, it sounds great, I can commit X amount of dollars. Well, soft commits are not anything that I put weight on anymore. If I go to one of the partners and I say I have a soft commit of 100,000, they know I may have 50. So now I've learned when we have our deals, when we talk about our management calls leading up to the closing of the deal, that's what I'll tell them is like, I have about 100 soft committed. Let's say it's 50 that I'm going to get. But until that money hits into the fund and into the account and is wired, I don't count it. But it was constant communication. It's constantly, Brian mentioned it earlier. If you're doing a 506B, I can only talk to family and friends and people I know. You cannot advertise that. You can do what you want. You shouldn't advertise that. If it's a 506C, that's open to accredited investors or sophisticated investors only. You can post that all day long. And so this particular deal was a B, so I could only talk to family and friends and I had in my acquaintances, and it's a lot more conversations. It's way easier. We had another deal we didn't come through. We had another deal that was a 506C. I could just put it on LinkedIn and people called me. So that's the other hard part is just, realizing how to navigate that. But I am constantly talking. I don't have a deal right now, and I still stay in touch with investors just to keep the finger on the pulse, find out what they want. Because some investors want cash now. If they're retired and they need cash flow, then I know I can't go to them with an equity play that says, hey, if you get in this deal now, you're 100K. If everything goes as well, you're going to get 200 on the back end and it's going to be a 2X multiple. They're like, that doesn't do me a good, Keith. I've retired. I need cash flow now. Well, then I know those investors, they don't check that box. I usually don't tell them about that deal because I look at you all. If you are my group of investors and I know half of you want cash flow and half of you want equity, I would lose some credibility if I bring you a deal to those of you that want cash flow that I tell you it's an equity play. I might have an off conversation and say, hey, Fred, I got a deal. It's an equity play. I don't think it's good for you because you want cash flow. That's all I say. And then if they want to know more, they can ask me.
Yeah, Keith, you brought up a couple of things that I want to go back and double back on. One of the there's so many rules you have to be aware of and follow correctly. And one of the rules you brought up is you can't get compensated directly for raising money. So if you're a GP in a deal and you're getting paid just for raising money, that's a big no-no, and you can get in a lot of trouble. So that you have to have some material participation. In your case, you're part of the asset management team as well. You brought up 506B and 506C, and I kind of want to go down that road because these are key distinctions here. The SEC, like if you were to just raise money and file with the SEC, it would cost you hundreds of thousands of dollars to do so, to raise money. But they have exceptions. And the most commonly used exceptions are 506B, 506C. And I'll go into a little bit more detail on each one. So 506B is friends and family. That's where you're only talking to people who are already in your network and you have a substantial relationship with. And the benefit of doing 506B, and so far, I'm about to do a 506C, but so far, all of my investments have been 506B, people who are established in my network. And what that allows me to do is raise money from accredited investors. And how many people know what accredited investors are? Okay. So for those who aren't sure or those listening on the podcast, an accredited investor is someone with a net worth over $1 million, not including the value of their home, or they make over $200,000 a year at their W-2 job, or they have income of over $200,000 a year individually, or with their spouse, $300,000 a year. Those are the basic rules of what it takes to be an accredited investor. So you can raise money from as many accredited investors as you want. If it's in a 506B, where these accredited investors are part of your network already, you don't need to verify that they're accredited. You don't need to look at their tax returns, or they just self-verify themselves. The other benefit of a 506B, B as in boy, is that you can also raise money from sophisticated investors up to, up to 35?
35.
Up to 35. And a sophisticated investor is someone who doesn't meet accredited investor qualifications, but they're sophisticated enough to know the risks that are inherent in investing in these types of real estate syndications. Meaning, maybe they own rental property themselves, or they have a good stock portfolio, and I always say to investors, don't invest money that you can't afford to lose, because there's always risk in any type of investment. So that's 506B, and you can raise money from friends and family. What is that, 30 minutes? Okay, thanks. You can raise money from friends and family, and they have to be in your network. Now, 506C, the other thing with 506B, this is key, is you cannot advertise publicly. Like, you can't go on Facebook. You can't just meet a stranger and say, hey, I've got this apartment I'm raising money for. Why don't you invest with me? Unless they're already established in your network, you can't raise money from that person in a 506B. Okay, 506C gets around all that. I can talk to I could raise money from all of you, even if I've never met you. If I'm doing a 506C, I can go on Facebook, I can buy a billboard on the highway, but you have to be accredited. And you have to be verified by a third party as accredited. So that might be your CPA writes a letter saying, yes, my client is accredited, your attorney. There's third-party companies that will verify you, but that's what's required in a 506C. And there's no sophisticated investors allowed in a 506C. Did I cover that pretty well?
Yep.
Okay.
Yep.
Gary, you've done 506Bs.
Yep. So I've actually done, so there's a 504, which is the true friends and family. They don't have to be accredited. They don't have to be sophisticated. That's where you take grandma's money. They have requirements where you can only raise up to 10 millions. It can only be within a 12-month period, and you have to follow all your state's blue sky laws, which means you got to file with your state as well. That's what most people are typically doing when they're first getting out there, and they've got their real, their brother's money, whatever they're doing, where they're actually breaking the rules. You're probably not going to get caught, your own risk tolerances, but there are rules about that. So that's the 504. Once you get to the 506B, it's in your network. And the network, there is no definition. The SEC has not said this is what counts as having a relationship. The rules of thumb are that it's a previous relationship before you talk to them about investing, and that you have a reasonable understanding that they would be accredited. So some people take that on, in your network. If you are talking to a doctor who's been a doctor for 10 years and lives in a giant house, and you've met them a couple times, and then you talk to it, they might not be a real friend or family, but they know you're a real estate syndicator. You can still bring them into a B, even though you're not a real friend. You just have a previous relationship. There's a lot of tools out there, a lot of softwares that will help you establish that you have that relationship. I know I use one based off Appfolio, where if you want to talk to me about stuff, I make you go and sign up through my website, and it marks whether you're accredited or not, at which point you've now proven that you came to me. We have a relationship. I have a reason to believe you're accredited. Then once or twice more we'll talk, and then I can talk to you about an actual investment versus like the theory of what we're doing. And that can get really frustrating with people because they'll reach out to you on LinkedIn and say, oh, I hear you do real estate. Let's talk about that. I can't talk about it with you. I can talk to you about what your goals are. I can talk to you about the ideas of our game plan, how we operate as a business. And then, like I said, there's no set rule, but 2 or 3 conversations later, then we can actually talk about funds that we have available.
Yeah, you have to establish that relationship. First.
And so that's the big, the friends and family is good, but you don't have to be afraid and go all the way to C before you look for other investors that are out there.
Well, Keith talked a little bit about raising money and what that was like. What was it like for you the first time you raised money? Gary, this is a question for you.
The first time, it was easier, I think, because I didn't know what I was doing. I just walked up and started asking to everyone what I could for money. And since it was the first time I'd ever done it, people gave me some money. Once I've taken their money, they no longer have it to give. And so then I had to start looking for new people. That's when it got hard. Like I said, the first time was easy. People saw I was successful. They knew me. There's a pool of money that's out there for everyone. If you just open your mouth and ask for it, it's probably there.
Mm-hmm. And then you also talked about some of the tools. And this is another thing. Like when you're raising money, there's a lot of CRM, which is what customer relation management software, portals to house all the information. I use an investor portal. I've been through 2 of them so far that kind of track the investment for those who invest with me, and they can see all of their investments and how their performance is, and then get the updates and everything. What kind of tools, Keith, have you found to be helpful in raising money through syndication?
So he's right. CRM is important. And going back to what I mentioned earlier about keeping those, your finger on the pulse of the relationships. And as they both alluded, how you want to prove you have an established relationship. I use a website called Wix, Wix. It's reasonably priced. I paid them to do my website for my company. It's linked together, just like Gary said. If someone, it's on all of my emails that you can either book a call on my Calendly calendar. You can go right to my website, and it has people sign up. So it does prove for my comfort that someone's coming to me. And I would do the same thing that Gary mentioned. And so the other thing that's nice about Wix is it's a marketing campaign. So I can go in and just set up general emails, and Brian's actually probably gotten some. They pop out. They're pretty easy once I set them up, but they pop out. I set the time. It's usually 8 a.m. on a Monday, 8 a.m. on a Tuesday, just because that's when people are getting ready and they're up and at their computers. And then they can either reach out to me or they can have interactions because they'll click on links. And then I have each of those contacts in there that I can just go in and add a note. And I say, oh, Gary and I talked today, April 25th, and we talked about just general fund investing. And then he probably has that on his end. Some will go as far as to record with like otter notes. I don't do that yet. I'm an old school person that wants to just write stuff down, probably the control side of me. That's one I really like. And then unfortunately, and I say this unfortunately because of the different deals I've been in, I've dealt with Cash Flow Portal. I've dealt with Syndication Pro. I'm now dealing with Agora, I think is another one. There are a lot of them out there. They are fantastic. Fortunately, Cash Flow Portal, I have 2 of my investments in, which is kind of nice. that to Brian's point, I can go in there and look at them and see how they're doing. But those are the main ones for me. And then, like I said, just keep track through my calendar on the calendar link. And then if people come to my website and sign up.
So Wix is WIX, right? So I had no idea Wix did CRM. Because I use them for my website. I designed my website through Wix, but I didn't know they did CRM. So that's pretty cool to know.
And the other thing that was nice about it is because they developed my website, when someone clicks on there and signs up, it just gets imported into my Wix CRM. So they're there.
Okay, good to know. Gary, what kind of tools do you find useful?
Like I said, I'm on AppFolio because it's a property management company. That's what we use. And so we're able to actually pull all of the data from our properties directly into our portal. And it makes sending out investor updates very easy. But same thing, it's tracking that relationship, because while we all play a little loosey-goosey with rules and stuff like that, we are dealing with the federal government. These are securities. These are people's livelihoods. You do have grandma's money. You have a responsibility to maintain and protect her. So when you are starting the relationship, you want to be able to track every moment. Like I said, the software programs, they will track each email and record every single email. You'll connect it to your emails, and they'll record every single email you've ever had with these people, so that you can know what you are doing, how often you're talking to them. And then for fundraising, it's kind of off to the side, but having a good lawyer, a reputable lawyer that actually draws the documents, while not a software tool, but having those people in your corner so that when you're talking to people, you know that you've done it right. That gives you the confidence when you're presenting things, and then the confidence that you're actually caring about doing things the right way.
Yeah. So following up on what you both said. So yeah, a lot of attorneys will tell you they can draw syndication work, but unless they do it all the time, I would not hire them to do the syndication work. So I would find a group that is what their specialty is, and they understand the syndication laws in all 50 states, because I've been with attorneys who say they can do it, and then it becomes a nightmare because I end up having to do most of it myself. So now I work with a group that does this exclusively. Let's talk about the legal work, because in my experience, there's 3 very important documents that need to be produced by my attorney when I do a syndication. Number 1 is the private placement memorandum, and that's referred to as the PPM. And the private placement memorandum basically is a legal summary of the investment. It contains all the details, all of the disclosures, but the most important thing that it contains is all of the warnings of how you will lose your money. Because that is what a sophisticated or accredited investor needs to understand, is that there is a very real chance, as slim as it may be, that you could lose the money that you're investing. And the PPM is what covers our ass when we raise money, because it says, there could be nuclear war. There could be, and we've had this acts of God like COVID, things like that could really affect the value of this investment. So the PPM discloses all that. The next document is the operating agreement. And there might be one operating agreement for the entity. If you're buying an apartment building, it's apartment building LLC. And it's just like any operating agreement, discloses who the managers are, anything else that needs to be disclosed. And contains a lot of the information that's in the PPM, but it's in the operating agreement format. Occasionally, I'll have a separate operating agreement for the management entity, which creates a little bit more tax cost at the end of the year. But usually there's an operating agreement, a PPM, and then a subscription agreement. And the subscription agreement basically is what the investor is going to fill out with all of their information, social security number, address. How are they investing? Through a trust, through a self-directed IRA, as an individual? What's the address to contact them? Email? What's the amount? The investor would fill out that subscription agreement. And also, if you're doing a 506B, the subscription agreement contains the accredited investor qualification or sophisticated investor qualification, where the investor would indicate whether they're accredited or sophisticated. They sign that, fill it out, wire their funds as an investor. Once those funds are received, myself as the manager and the general partner would then accept the subscription agreement and sign it and put it on the portal for the investors' records. Did I cover all that pretty well as far as legal?
Yep.
Yeah. So very important to understand what the legal is. Now, I've certainly had conversations with people who say, oh, well, technically you don't need to have all that. You can get around all that. You don't have to have it. Or they try to do it themselves. They take someone else's PPM and operating agreement and reconfigure it for whatever they're doing, so they don't have to pay the $12,000 to $15,000 to an attorney to have it done. I think that that's a big mistake, and I think that that's a big red flag too.
Yeah, don't invest with that operator.
Yeah. So anything to add to that?
The biggest thing where I see people make mistakes is in the operating agreement. The operating agreement is where you lay out, it's like a prenup. It's where you lay out exactly how everything's going to run. And it needs to cover situations 5 and 10 years down the road. When someone's talking about valuations, if you need to raise more capital, if something goes wrong and you have to do a capital call, how is that going to happen? If it comes from an outside source, how are you going to value the new money? If someone wants to leave, how do they leave? What are the mechanisms where you can force someone out if someone becomes, as a GP, you could get someone who, falls off a bike, gets a concussion and has a new personality, and you don't want to deal with them anymore. They need to be protected. Their assets need to be protected, but you also need to be able to remove yourselves from a financial situation. It's a prenup. There's so many things that change over the years, and especially, for example, in the fund model, because there is money that's coming in and out. You have to think not just what if things go bad, but what if things go well? How do you value things? What's money look like? What are the processes in place to determine what you're going to do in 10 years? If you're doing a single asset, what's the exit strategy? What are the options for different exit strategies? Is it a conflict of interest? There might be an exit strategy where you want to keep the asset. Well, that needs to be laid out so that they don't think that you're, stealing the asset from underneath them or something like that. So all that stuff has to be in there. You can very easily do a boilerplate operation agreement that just says, here's how we're going to operate. The GPs have the rights to run everything. You're going to be getting your distributions like this. That's the easiest part. All the concerns, I've had LPs die. What happens when they die? I had an LP die whose wife was an investor too, as a separate entity. The operating agreement, this was one of my first ones, I didn't have it in there. It said that when they die, it automatically forces a buyout, but her heir, or the estate's heir, is already a member. We didn't want to buy her out, and she didn't want out. So we had to actually pay and, get that amended because the operating agreement said we had to buy him out.
Yeah. Many times we've had questions come up. And how do we handle this? Well, the answer is look at the operating agreement. What does it say? Let's refer to that, because a good operating agreement will cover just about every single situation that can come up. And that's why you need a good attorney to put that together.
The PPM's easy. You're going to lose your money. The PPM's easy. Yeah. It's the operating agreement. You got to spend the time.
Earthquakes, natural disasters, nuclear war, meteors hitting the earth. It's all going to happen, and that's in the PPM. Mm-hmm. But the operating agreement is what you live and die by. I think we should take some Q&A. Does anyone have any questions? And remember, we have to repeat the questions. Nathan, go ahead. Can you stand up and speak a little louder, please?
Really interested in indefinite hold strategies, and most traditional syndications seem to be a lot more focused on pre-tax IRR maximization, like focused on short term. Are there any strategies or tactics that you guys use that focus on like the long-term post-tax returns that a lot of LPs actually want?
So don't sit down yet, because I'm not sure I understand your question. We tend to see a lot of syndications that focus on pre-tax IRR and maybe don't take into consideration a long-term hold.
Right, because the GP wants to earn their promote. So if the fund model may be different, but if you've got a specific asset, you go in, you fix the problem. The way that the GPs earn their promote is on exit.
Mm-hmm.
Whereas many LPs like me, I would rather hold on to that asset versus having to redeploy it. So it's a way for the GPs to earn a promote in a syndication and then continue to own the asset for the LPs versus them having.
Why don't you kind of
So
repeat what the
your
gist of the
question is, instead of a short term guarantee, 5-10 years later you're going to sell, and now the deal's over and it's gone. Is there any long term buy and hold forever type situations? Yes, it's something I've been looking at doing. Specifically, there's an investor in my area. I've been talking to him for years. He had some family office money that he got access to. They just want to make money forever. So he designed a purchase of several apartment buildings where after 5 to 10 years, they were going to do a cash out refi that pays everyone out, at which point there's no money from the LPs in. He retains the vast majority of the ownership, and the LPs take a slightly smaller percentage for the rest of their life with no money. They have no rights. They're never going to sell it. He's going to own it until he dies. It's going to go on to his kids, but the GPs are going to get paid forever on it. And they've already got their money out with a 5 to 10 years. And as long as that's spelled out in the operating agreement, you can create any legal structure you want.
Yeah.
And what
Go ahead.
just as being new, and I'd like to touch on that a little because I didn't understand that at first either. When I first got into real estate, I thought, why wouldn't you just buy and hold everything and just cash flow like crazy? It wasn't until I realized the velocity of capital and maximizing your capital to grow wealth. So now I've turned it to initially with these syndications and even my single families, because I'm actually starting to piece those off and take that equity and then buy into other deals. So the best way I can explain it, that was explained to me, if you buy a deal and let's say in 3 to 5 years, if all goes as planned, you sell and you double everybody's money. Nobody's going to be upset that they've doubled their money in 2 years, myself included. And then what that allows you to do is, let's say you invested 50 in the first one 5 years ago, and now you get your 50 back plus another 50. You now say, that was great. Now I'm going to go buy 2 deals at 50. And then it becomes, next time I'm buying 4. And then you start just multiplying capital to build wealth. And my goal, and what I've had other people tell me that are way smarter and doing this longer than me, is then when you start looking for those long-term, just infinite return on investments, because then you can start saying, all right, I've doubled my money twice in 10 years. Now I want to take some of that money and put it in a deal where they're going to cash out refi in a deal and say, hey, Nathan, here's your 50 you gave us. You're getting that back. Go invest it somewhere else, but here's your same amount of LP equity in this deal. And then you get that annuity. They're out there. You just have to look for them. And it also goes back to what I said earlier when I'm talking to capital investors. What do they want? That's how it's explained to me. And that's what I'm doing as a newer investor, knowing that right now with my W-2, I'm just trying to grow wealth. So when I'm ready to walk away, I've got those multiple streams of income.
Yeah. And I think part of your question has to do with the incentivizing for the general partner and the limited partner. In the past 7 years or so, the incentive has been, let's get in and out of this deal within 3 to 5 years, because that's how everyone's going to make money. But that has shifted because of interest rates and the economy. So you have to figure out up front, well, how do we incentivize the GPs to do the best job possible and make sure they get paid while still prioritizing the limited partners? And that's always a challenge when you set up the structure for any syndication, is how are we going to take this pie and split it up and slice it and dice it so that there's incentives along the way where everyone wins. And that's always the biggest challenge when you're putting together a syndication. You had a question there, sir.
Me?
Yeah, you.
Yeah, so I would be curious to know how you guys, as you've done different deals, how you've split that GP table and how many partners you guys have generally used within different deals.
Yeah, it's different for every deal. Are you talking about how do we split the
So just the general part.
just the general
Like
partners?
splitting if they have 20% of equity, how does that get split? Okay. Yeah, go ahead.
Yeah, so I've done it where I have had no general partners, so I get 100% of the GP. I've done it where I have up to 3 or 4 general partners, and in my situation, it's always kind of been an even split, unless there was more work on one person's behalf, and it was clear and spelled out up front, like who was responsible for what. So, but typically when I when I'm partnering with someone, we're both bringing something very important to the table, something very different from the other person, but something very important. And we split that pretty equally.
And I can tell you, just for the couple that I've been in, there seems to be more weight put on who finds the deal. Because if they're the one that is the initial syndicator and doing a lot of the work, then they sometimes say, well, I'm taking 30, and they'll structure it. They'll say, I'm going to take 30% of the GP split. I'm going to give 10% or to the key principal or who's ever going to guarantee the loan. I'm going to split up 25% with capital raisers. And my math is not adding up to 100. I'm going to give 25% to the asset manager. And then all adds up to 100. And probably like Brian's talking about, if you have, let's say, 4 people doing that, but one person's doing 2 jobs, well, they might get to 10% as being the loan guarantor and 30% for being the one that found the deal. So they get 40% of that. And then the other 30% or 60% is split up, let's say, 3 people, 20% way. But it goes back to what they've all said too with the operating agreement. That's where you get an operating agreement within the management of the general partners, because it will clearly say, this is who's getting what math. And it varies. It absolutely varies. I've had some key principals, when they're going to be the loan guarantor, they won't take less than 20%. And that's just because they can. It's bad to say
20% of the GP.
20% of the GPs.
Yeah. So
20%.
Think of a pie, and that pie is usually split. And this, I'm just going to give you the traditional split. So let's say 70% of that pie is the LP. That's where they get their profit from, and their equity is 70% of that pie. The other 30% is held by the GP, the general partner. Now, when a guarantor, and I think you mentioned the word guarantor. A guarantor is someone who signs on the loan with the lender and says, I will back this. Like if this loan goes into default, you come to me and I will make sure that it's taken care of. That's the guarantor. Sometimes they will get up to 20% or more of the GP slice. But that's not 20% of the whole pie. That's 20% of the 30% that goes to the GP. Does that make sense? Yeah. Gary, do you have anything you want to add to that?
No, that's, yeah, whatever you have to pay to get them to participate.
Yeah. Nick, you have a question?
Syndication deals that I've seen seem structured so that the GPs do very well with fees. And I've always struggled to figure out what the interest kind of the question over here is. As a limited partner, it seems in the best interest of the GP to not only refinance, which obviously could be good for everybody, but also sell pretty quickly. So often there's a development fee up front for putting the deal together, and then there's finance fees, there's an exit fee. I guess looking at that, what is the limited, as someone who might join as a limited partner, what am I missing? Because it seems like that's really exciting.
Well, yeah, I don't think you're missing anything. So the question, to repeat for the podcast listeners, was the incentives for the GP. You see a lot of upfront fees and then, developer fees, acquisition fees, and then refinance fees or sale fees. So the general partner side has really loaded up a lot of fees, and that's how they're getting paid. Is that kind of the gist of what you're asking? So what's behind all that? Well, I guess what's behind all that is that the general partner, needs to make money. This is how they make money. And, they don't have the W-2 job, so they get their money from doing these syndications and hopefully bringing quality investment opportunities to people where even, with those fees, which should all be disclosed in the operating agreement and the PPM, there's still enough pie and meat on the bone for the limited partners to make money too along the way. One of the things that I always make, because you want to, as a general partner, when you're putting together a deal or a syndication, you want to make sure that you're compensated properly and accordingly, but you also want to protect the limited partners who are investing. And because as a GP, if you don't get enough of the pie, then you can run into problems, because then you lose interest and it's like, why am I even doing this? Because I'm not making any money. All the money's going to the investors. So there's that side of the equation, but you want to protect the investors too. So what you often see is a preferred return. And this is money that goes to the limited partners before it goes to the GPs. So there's all kinds of ways to balance the scales to make sure that the GP is compensated appropriately through some of the fees that you mentioned. And frankly, some of those fees are exorbitant. I mean, there are some syndicators out there who do it just to make the fees and make the money, raise the money, make the money off of it, and they're not as concerned with the performance. So as a limited partner, it's very wise to read through the operating agreement and make sure you understand what the incentives are. But there are ways to balance the scale so that the GP is compensated accordingly and the limited partner is protected and compensated accordingly as well.
So one thing on that, the important part is the incentives. You want to make sure that your incentives are aligned with your LPs. And as an LP, you want to make sure that the GP's incentives are aligned with you. You want to make sure that they're making money when you make money. As long as that's the case, you'll know that they're going to make the right choice for you as well. Everyone has to eat. You're going to spend however much, or you're going to have to charge someone either up front or on the back end. I'm the same way as you, Nick. I have a hard time charging the fees, so I don't charge any of the upfront fees, but my back end's much higher than the average person. In the end, it's the same. You just need to, as an LP or a GP, make sure you're aligning your incentives.
And I would say, Nick, being that I was in your shoes as an LP, and then I had that question posed to me when I was a GP raising capital. It's valid. Everything they said is absolutely true. GPs don't make their money. They're either going to make their money on the front end and the back end. And that deal has got to work if they're going to make money on the back end. But the way I look at it now is if I look at the deal and I think the deal, and I'm happy, let's say if I'm happy with those returns, I really don't care what they charge me as a GP. I will go back to when I was looking to flip houses and I'd buy from wholesalers. I really didn't care if a wholesaler charged me $20,000 to buy a house. If I knew when my numbers were together, I still made what I wanted and I was happy with my returns. That's a very broad general, but I really don't care what someone charges me if I know those returns are what I want. But what I now piggyback off when I'm looking at an operator, because not all operators are created equal. You know, if I vet that operator, if I don't think that operator is worth their weight in gold, I'm not investing in their deal no matter what. But if someone like Brian that I trust says to me, or the team that I'm with now says to me, hey, we've got we're charging a 3.5% acquisition fee and whatever else fee in there, and it's loaded on the front, and I trust them and I see their returns and I say, hey, those returns line up with what I want, and I trust those operators, then I'm fine because I trust the operator. If I have questions about that operator, I'm not, even as a limited partner, keen, and even as a capital raiser, I won't put my investors' money at risk as a capital raiser if I don't like the operator and I'm afraid of those front-loaded fees.
So that's all we have time for. It's 9:00. We have to wrap it up, but we will stick around and answer any questions if you want to come on up and ask them. We'll stick around a little bit longer. Quick question. Yeah.
You recommend a book for a beginner getting to know about apartment syndication or just syndication in general?
Well, you recommended the Michael Blanc book.
Yeah, I think it's called Apartment Investing. It's very simple, but it's a yellow book. It is the little yellow book, you'll see it referenced a lot. And it was a very easy read. I don't like reading, but it was a very easy read.
Hopefully I'm not stealing yours. I don't know if it's a book or not, but Brian turned me on to Rod Cleef as a podcaster. Really good information there.
Yeah, Rod Cleef teaches syndication. There's a lot of people teaching syndication. When I started, the only person I could find teaching syndication was David Lindahl. But now there's 50 people teaching syndication. And Rob Beardsley, he was on my podcast recently. He wrote a book on capital raising. It might be called Capital Raising, but Rob Beardsley goes into a lot of good detail about raising money. So, all right, well, that's all we have time for. Thank you very much, everyone. And let's hear it for our panel, Keith and Gary. Oh, good job.
Good job.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.